Alright, welcome to episode 2 of How to Day Trade. Today we're going to be going over options fundamentals. We're going to be talking about all the pieces and parts that make up an options contract and all the stuff that y'all need to know. So we're going to be going over strike price, expiration, theta, delta, implied volatility, intrinsic value, and extrinsic value. Alright, so let's get right into it. So first of all, what is an options contract? Well, an options contract, it gives you the right, but not the obligation, to buy or sell 100 shares of a stock at a predetermined price before a certain date. Now, I say all of that, but what does that actually mean? Well, you basically just trading a stock, but one contract is 100 shares of that stock. So, you just trading stocks 100 shares at a time. The simplest way to put it is that you just trading stocks 100 shares at a time. So like I said, one contract equals 100 shares. Contracts increase or decrease in value before they expire. So if your bias is wrong, you think the market's going to go down and it actually go up, it's going to decrease in value, and vice versa. If you think it's going to go up and it go down, it's also going to decrease in value. But if you're right and you think it's going to go up and it goes up, then it'll increase in value and vice versa. So most traders never exercise their contracts. What they do is they just buy and sell them. An example of the way that they price contracts is like you'll see a contract on your I use Robinhood. So say Robinhood, a contract that's $2. The contract can say $2, but you'll have to multiply it by 100, making the price of that contract $200. Because the contract cost is based off of one share, and like we said, one contract is equal to 100 shares. So if you multiply it by 100, you'll have the actual cost of that contract. Yeah, it's gonna say $2. But to purchase that contract, you're gonna need $200. So like try to think of an options contract as a coupon that got a price, an expiration date, and value that change over time. And it's important to know that you're not trading the stock. You're trading the contract itself. That's an important one. The first part of a contract is the strike price. The strike price is the target price attached to the contract. It's basically the price that you're targeting. The value of a contract is based on whether the stock moves toward, above, or below that price. For example, let's say Apple was $100, right? The stock itself. And you wanted to buy a contract with a strike price of 105. Now in this scenario, the contract would make money if it moves toward 105. And it will make significantly more money if it moves far above 105. So I'm sure you can imagine that if it moves away from 105, that it would be losing money. That's basically how strike price works. So strike price is just the target price you're aiming for, basically. Alright, the next part of a contract is the expiration date, or the DTE. DTE stands for days till expiration. And it tells you how much time your contract got left. So if you had a contract that had 1 DTE, it'd be 1 day till expiration. If you had a contract that said 5 DTE, it'd be 5 days until it expired. And if you had a 30 DTE contract, it would be 30 days until that contract expires. So what determines a contract price? Well, there's a few things that determine a contract's price, and that's stock movement, time remaining, and expected future movement. Let's get into it. So delta, which is basically the stock movement, it just measures how sensitive the contract is to the stock moving. So delta just tells you how much the contract value moves when the stock moves. So for example, if you buy a contract with a delta of 0.5 and the stock go up $1, then that means your contract value will go up by 0.5. So like in the last example, we used a contract that was $2. So if that $2 contract went up by 0.5, it would be $2.50. But if we multiply that by 100, because we have 100 shares in each contract, that would be $250. So you put $200 into the trade, the stock moved up $1, so now you have $250 in that trade. If you take your money out, you would have made $50. So now we're going to talk about theta. And all theta does is measure how much value the contract loses each day from time passing. So for example, you buy a contract and the theta is 0.05. The contract is $2, right? The next day, if nothing else changes, the contract is now worth $1.95 because it lost 5 cents of value, which is really $5 of value because you put $200 in, you multiply $1.95 by 100, you now have $195 in that trade. So you'd be down $5 if nothing else changes and the price stayed the same. Not that the price would ever stay the same throughout the day, because people always going to be buying and selling stocks, so the price won't stay the same. But that's just a hypothetical example to make the math easier for y'all. Alright, so now let's talk about IV. IV is implied volatility. It measures expected future movement. So basically how much traders and speculators expect the stock to move. So a couple things that affect IV are company news, earnings reports, economic reports, product launches, major world events, lawsuits, and stuff like that. So for example, if Apple reported earnings tomorrow and the contract price today before earnings is $2, then tomorrow after earnings, the contract price could easily be $3 or more. A higher IV will usually mean higher contract prices, so try to keep that in mind. Now the last two we're going to talk about is intrinsic value and extrinsic value. Like, these things aren't as important as the other things we already discussed, but I still put them here because it's still good to know. So intrinsic value is the amount that the contract is already in profit. So for example, if the stock price was $110 and the strike price was $100, then the intrinsic value will be $10 because the stock price is $10 higher and the intrinsic value comes from the stock price. With extrinsic value is the portion of the contract's price that comes from the remaining time and expected future value. And I know it just sounds like a bunch of words, but what you're basically doing is you're paying for the chance that the contract becomes worth more before it expires. And the calculation for extrinsic value is contract price minus the intrinsic value. So if the contract price was $12 and the intrinsic value was $10, that would make your extrinsic value $2. It would be the remaining value of that contract that's not intrinsic. So, like I said though, you don't really need to know much about intrinsic and extrinsic value. It's just that much more helpful to know. You can start options trading without even knowing what that stuff is. You can be good at options trading without even knowing what those two things are. But like I said, it helps. So now that we went over the need to know for contracts, I'm going to be showing y'all on my phone what it'll look like when it's time for y'all to actually trade this. Now I trade on Robinhood, so if you don't trade on Robinhood, it's going to be the same thing, but it's going to have a different layout. But it's all the same stuff. So we looking at the S&P 500, and the ticker symbol for that is SPY. You'll see it at the top left. And a ticker symbol is just like the abbreviation of the stock. Like for Apple, it's AAPL. For Tesla, it's TSLA. For S&P 500, it's SPY. So we just call it SPY. Anyway, you click on trade, and then you go to trade options, and it's gonna pull up a bunch of dates. You see all these dates right here. When you place an options trade, if you want to be safe with it and not risk all your money and be gambling, you don't want to pick an expiration date that is close to today's date. So right now, while I'm recording this, today is the 8th. The market is closed anyway, but if the market was open, if I was to place a trade today and it expired on August 10th, which is 2 days from now, it would be a riskier trade than if I placed a trade that expired August 19th, which is at least, 2 weeks from now. So if you don't want to take on a lot of risk when you trade options, you want to make sure that your contract expiration date is further out, at least 2 or 3 weeks. So August 19th will be a good date. August 18th, 17th, those all would be good dates if I was to be trading today. However, like I said, it's the weekend and the market is closed. So if you look here, we got a bunch of options contracts that expire on August 19th. And they got the strike price on the left with the actual price of the contract on the right. Now in the middle of the screen, you'll have the share price of whatever stock you're trying to trade. And that'll just tell you what the stock price is. For one share, you need $773. All the contracts on the bottom half of the screen are more expensive because that contract is already in profit, meaning it already has intrinsic value. So everything on the top half of the screen, the price of the stock hasn't even reached that price yet. So they're less expensive because it's more risk you're taking on because those contracts are not in profit yet. So what smart traders do is they'll buy a contract that's already in the money. Me personally, I'll pick one of the first 3 that's right under the share price, because with those first 3, you're gonna have a delta of around 0.5 to 0.6, and that's why I aim my deltas at. You can aim for higher or you can aim for lower. It depends on the type of money you're trying to make from your trade. I think 0.60 or around that 0.6 range is a good range for a delta. That's what I mainly look at, because like I said, the delta just determines how much the contract will move in value when the stock moves. So a 0.6 is $60 for every dollar. So let's look at this first one. Like I said, the stock is at $773.38. So it's already in the money, but it's only in the money by 38 cents. So it's not likely to be at a 0.6 delta, but it's probably at a 0.5 at least. So when we click on it, we'll see all of the information on this contract. You can see that the delta at the bottom where it says the Greeks, you can see that the delta is 0.53. So if the stock move up $1, your contract gonna go up 53 cents. But like I said, when you multiply it by 100, that's $53. So you would have made $53 if the price goes up to $774.38. And the more it go up, the more money you make. And the theta is a negative number, but that's because you're losing money every day that passes. And like I said, theta is a measurement of how much value the contract loses from time passing. So you lose 29 cents on the contract every day. If it stayed at the same price, you would lose only 29 cents. But 29 cents multiplied by 100 is $29. So you'd be losing $29. And you can see at the top right, it says IV. The IV is at 10%, and that's not a high IV. It's actually a low IV. Anything below 20% is pretty low. Anything 50% or higher is a high IV. So the in-between would be like a normal IV. So this stock isn't very volatile right now, but you know, the market is closed, so there's that. Now, if you wanted to actually see how this stock would react to price movement in real time, you can look at that on this app, and all you have to do is add it to your watch list, like I just did by clicking add up to the watch list, and then you go to open. So when you go to this, you can see where it says simulate my returns. Now, like I said, the stock was already in the money, so it's already up $4. Now, if it went to $774.38, the contract will be worth $59. And this is an estimation. It's not always going to be exact because they can't factor in everything at one time. But it gets you really, really close. Like so close that it's almost not an estimate. But it'll get you real close to how much money you'd have at that price. And as you can see, if I move the vertical line to the right, you can actually see the rate that the contract loses value from time. So August 9th, you see it's losing value the more I go to the right. August 11th, August 12th, 13th, 14th, all the way down to the end. If price stayed the same all the way up until the expiration of August 19th, which is not likely to happen at all, you would lose $479. So this is a good tool to have if you want to know how much money you'd make when you reach your target, or how much money you'd lose if you hit your stop loss. So that's everything that you need to know to actually trade options. In the next video, we're going to talk about reading charts, which is also known as technical analysis. And I'm going to be telling y'all everything y'all need to know to actually find a good trade setup. So once you're able to read the charts, you'll be able to know the direction of the market and place a trade with confidence. So if you got something out of this video, make sure you like and subscribe. If you got any questions, leave a comment and I'll get back to you. All right, I'll see y'all next week.